Debt Market Update, January 2022. The 10-year benchmark GSEC yields rose by 23 basis points in January 2022, driven by concerns over accelerated tapering and possibility of aggressive policy rate increases by US Fed. Rise in crude prices, elevated inflation in advanced economies, strengthening USD, etc. also impacted the yields. Corporate bond yields also rose, albeit at a slower pace, and thus narrowing the spread with GSEC. Average net interbank liquidity remained in ample surplus, albeit lower than last month, on back of GSEC and foreign exchange selling by RBI. FPIs bought net debt worth $0.4 billion in January 2022 and have cumulatively bought net debt worth $3.7 billion in 10 MFY 22. Outlook. While the switches done by RBI during end January 2022 resulted in decline of yields, the GSEC yields rose sharply post-budget, driven by higher than expected market borrowing announced for FY23. Lack of clarity regarding tax issues for inclusion in global bond indices aggravated the rise in yields, and 10-year benchmark GSEC yield has risen by 15 to 20 basis points post-budget. Overall, multiple factors are stacked against the bond yields in the near term. These include accelerated pace of tapering and rate hikes possibilities by US Fed and other major central banks, resilient retail inflation, especially core CPI, elevated WPI, high SLR holding of banks, good recovery momentum, high global inflation, etc. Further, unlike the past 2 years, where RBI monetary policy played a supportive role in ensuring successful completion of government borrowing programs, meeting the borrowing requirement could be relatively difficult, with RBI also initiating normalization of monetary policy. Thus, all the aforesaid could keep upward pressure on GSEC yields. On the other hand, ample surplus liquidity and possibility of ironing out issues related to global bond index inclusion could ease pressure on yields. Also, while RBI interventions in bond markets have reduced in past few months, in our view, it is likely to intervene in case the yields rise sharply. Further, while inflation remains high currently, based on 1-year forward estimates, the real yield is approximately 150 basis points, which is attractive for long-term investors. Again, market borrowings could turn out to be lower than expected due to lower fiscal deficit and/or higher than estimated NSSF collections and/or government using cash balances to fund the deficit. On an overall basis, we believe that yields are likely to trade with an upward bias given the demand-supply imbalance of market borrowings. Further, gradual normalization of monetary policy is also likely to push upward pressure on yields, especially at the shorter end. In view of the aforesaid and relatively steep yield curve, we continue to recommend investments in short to medium duration debt funds, possibly in a staggered manner, in line with individual risk appetite. While AAA rated corporate bond spreads have reduced significantly since last 1 year, the spread of non-AAA rated corporate bonds vis-a-vis AAA rated bonds remains higher than historical average, and thus we believe opportunities exist in select pockets of non-AAA rated bonds. Hence, allocation to credit-oriented schemes or funds with some non-AAA exposure could be maintained or increased in a phased manner, in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.